In this video, I am going to talk about something very important for retail investors. So, in investment management process, one of the primary steps is to define your goals, right? And when you define your goals, you primarily define a benchmark, meaning how much return you are expecting from your investment. And in order to define a benchmark, you need to understand how to calculate expected returns. If you have no idea about how to calculate an expected return on a certain stock or on your portfolio, then it becomes more of a guess game than proper investment. So in this video, I'll help you with understanding how to calculate expected returns in advance on stocks and on your portfolio, which will help you with your asset allocation more properly. So the model I'm going to be using for this calculation, there are several ways of doing this, but the model I like most is CAPM, Capital Asset Pricing Model. Let's have a look at it, and then I will comprehend it accordingly. Let's have a look at Capital Asset Pricing Model. Capital Asset Pricing Model says expected return on your investment is equal to risk-free rate plus beta of that investment into risk premium. Now there are three components to this equation. Number one is risk-free rate. This is quite simple. This is basically the yield on 10-year treasury. I think right now it is sitting at 3.6 in the vicinity of this number right here. You can look up 10-year treasury yield on Yahoo Finance or on your brokerage account, and you can take that number as risk-free rate. Now the second component is beta. Beta is basically sensitivity of a stock to the sensitivity of the market, meaning how much your stock will move when market moves by 1% in either direction. If you have a lesser value for a beta, that means your stock is less risky, meaning it moves less than market. If you have a higher number or higher value for beta, let's say if you have a beta of 2, that means when market moves by 1%, your stock moves by 2% in the same direction. Now the third component is the risk premium. It is essentially the difference between return of market minus risk-free rate. So historically speaking, this return on market has remained 11.9%, minus risk-free rate right now is 3.6, right? And we'll have to plug in beta of the stock or portfolio which we are solving for. Let's do this for Tesla. Let's see how much expected return or how much return we can expect from Tesla. Let's plug in beta of Tesla into these numbers and see what does it tell us. Plug in numbers for Tesla. Let's solve it for Tesla. First of all, beta of Tesla is 2.11. That means when market moves by 1% in either direction, it almost moves by double in that direction, 2.11. So I had to look up the 10-year treasury. It's right now sitting as 3.8, not 3.6. So I had to correct that as well. Risk-free rate is 3.80. Now the risk premium, the difference between return of market and risk-free rate. Historically, market has returned about 12%, 11.99, and the risk-free rate right now is 3.8. So if you do the difference between that, it comes up to 8.19. Now solving for Tesla, risk-free rate plus beta into risk premium. The risk premium number is 8.19. Multiply that by beta, it will come up to 17.28. Add that to the risk-free rate, comes up to 21.08. So according to this model, Tesla has an expected return of 21.08%.